Hey, let me just make one thing clear here. I don't follow politics to gain insight or facts. I only follow politics to assess sort of social and economic trends. Now, I find so much of the political coverage to be about gossip or drama. I mean, obviously, though, I'm in the minority. Heck of a lot of the public and media love politics. The coverage is 24/7. So in order to fill the time, sooner or later, usually sooner, it gets filled with innuendo, speculation, gossip, which, by the way, is the foundation of fake news. And besides, for me personally, I find that people who are caught up in politics are nasty, they're unreasonable, their political affiliations trump values every time. For example, I'm not sure what values violent protests represent that we're seeing today. You can't even have a reasonable conversation about any subject that's been politicized, let alone about Donald Trump. And besides, political coverage is boring. I mean, the norm in the media is to bring representatives of the different parties on to recite the very predictable partisan spin, but their goal isn't to illuminate or to raise the level of conversation. It's actually to obfuscate for their own ends. I find it just so insulting to my intelligence. There's absolutely no attempt to have a complete airing of the facts or prevailing research. It's simply opinion guided by no standard of accountability. They'll pay no price for being wrong, ill-informed, or purposely misleading. So, the bottom line for me is it's not worth my time. But here's my recommendation for that vast majority of people who seem to like it. You may like the drama, the speculation, the innuendo, but please don't confuse it with reality. Don't be misled into thinking it's important. The political establishment, including special interest groups like organized labor, the commentariat, politicians themselves, give me no indication they know what's going on. They didn't foresee the sovereign debt crisis in Europe or the emerging markets, the bankruptcy of Detroit, the junk bond status in Chicago, both due to unfunded pension liabilities. They didn't anticipate Brexit, Trump's victory, especially in traditional democratic states like Wisconsin, Michigan, and Pennsylvania. I mean, there's so many more examples of major events that they didn't anticipate or prepare for. So I say, go ahead, enjoy that drama, that gossip, that speculation, but please don't confuse it for what's really going on. Well, maybe President Trump's attempting to change that. I keep hearing he's all over the map. That's the theme today. That's the narrative. Things are chaotic. But I think that misses the point. Sure, I don't know what that guy's going to say or tweet next, but don't confuse that with his policy announcements. On that front, he's following through on the same themes he's been talking about from the get-go. And clearly there's opposition. But to say he's all over the map is ridiculous. I mean, he's been talking about a wall, stronger vetting of immigrants from the 7 countries where he wanted to put immigration on hold for 90 days. He's been talking about punishing American companies who move production to Mexico, or he wants, canceling the Trans-Pacific trade deal, or renegotiating NAFTA for what, a year and a half? He's been talking about lowering taxes, getting rid of regulations in order to put jobs in America first. So, like it or not, that's what he's been doing. He's anything but all over his policy map. I mean, don't confuse those Twitter rants with policy. So, maybe he'll be different at least on that front. He'll say one thing and actually do another. Or do it, rather. He'll say one thing and actually do it. But I doubt we're going to see any discussion coming from him or any other politician on the major issues that are impacting us. That's why on Money Talks, I ignore the political drama. I concentrate on issues and facts and research that aren't part of that mainstream political narrative. I mean, last week I talked about the recent update to the blatant threat to jobs in some industries due to technological substitution. As I said, maybe the political establishment is just starting to wake up to it. Maybe it was Mr. Trump's political success with blue-collar workers in manufacturing that may have been the catalyst. You won't hear politicians talk about the pension crisis, though. Maybe it's because they caused it. And by the time they admit to it, it'll be too late. At that point, you're going to be able to cue profound social upheaval. And it's coming. I think it's coming as soon as next year. What about the aging population? I talk about it because they don't. I mean, it was laughable to see the report from the finance ministry on the continuation of deficits at the federal level till 2050. The report cited demographics as a principal reason curtailing economic growth. Like we've just discovered, we've got an aging population. We won't start talking about the impact of the aging population on our healthcare system's financial viability until it's way too late. And if you believe the political narrative, you certainly won't see the demise of the European Union coming, which we've talked about in this show since 2009 because of the incredible impact it's going to have on stocks, currency, the social order. And in case you missed it, Greece is in default mode again. The second leg of the second bailout is being stalled, and the political will to stay in the EU is starting to be eroded. Are they the next ones to leave? In short, this is the point. you're not going to find demographic challenges, the unfunded pension problem, the impact of self-driving cars on jobs, or robotics and artificial intelligence on jobs, in that political drama and gossip that we so love on a day-to-day basis. Yet I'll tell you this, the financial and social impact of those trends is going to be far greater. Reminder, Money Talks is brought to you by Solera Club, and you can find out all sorts of information on Solera Club by simply going to soleraclub.com. Hey, coming up, I've got Dr. Michael Berry. He's going to join us at the top of the hour. Now, this is a guy who makes the presentations to the Federal Reserve. I just find it fascinating every time I get a chance to chat with him. Also, I got Michael Levy coming up in just a couple of minutes. A couple of big stories I think you should be following. I love my Goofy this week. It's part of that huge escalation trend in the trend of violence. And wait till you hear my shocking stats. All of that's coming your way. Oh, I should have told you this. I want you to stay tuned and listen to my quote of the week. I have never said that before, that I think you should listen to this quote of the week. I'm saying it now. Stay with us on the Money Talks Network. I thought Michael Levy would appreciate getting him in here with Marvin Gaye's Sexual Healing. Michael, there you go. 5 straight days or whatever it was, 6 days of market highs in the TSX and the Dow Jones. I mean, it's been a roaring kind of bull market. And again, maybe not such a big surprise, but led by the financials.
Absolutely led by the financials, Mike, and not a surprise, as you say, but maybe a surprise about how they've all hit record highs. We've watched them go up. I mean, take a look at Canadian Imperial Bank of Commerce some months ago, going from about $84 or $85 all the way up to $116. But 7 Canadian banks traded at record highs this past week: Royal, TD, Scotia, CIBC, BMO, National Bank, Laurentian Bank, Mike, all at their all-time record highs, and sent the TSX Commercial Bank Index to record highs last week in 4 straight days.
You know, one of the things that was really interesting at the World Outlook Conference, and I'll remind people, if you weren't there, you can still get access to the videos there by going to moneytalks.net. But one of the things that was fascinating was James Thorne talking about the rule changes in the States being an absolute supercharger for the financial industry. And lo and behold, we got the same thing, eh, Mike? I mean, I saw Goldman Sachs at an all-time record high.
Well, they did, Mike. They've been up 37% since the election of Donald Trump. Think about that. This is a bank stock, a conservative bank stock. This is what they used to call, in our day, my day in the business, the widows and orphans stock. You bought bank stocks because they were solid, very slow growth, paid a dividend that you could count on, but now you're taking a look at banks as being huge growth stocks, and that's really a big, big difference. And as I say, up 37% since the last election. And Mike, as you say, more yet to come from what came out of the World Outlook Conference. If they start to, in the United States, take apart Dodd-Frank, which was the bill that came in after the 2008-2009 meltdown in the markets, not just in the U.S., but worldwide, more regulation, having to keep back more in the way of reserves. If the Trump administration starts to undo that, then you could see a huge amount of more money just piling into U.S. banks, so there could be another explosion to the upside. But I always worry when people start talking about explosions or implosions.
Yeah. Hey, let me come back to the Canadian banks here. Obviously, they're reflective of at least something good going on in the economy. But, they're all reporting this coming week.
They are, Mike, and starting with CIBC on the 23rd. And the forecasts are to about a 7% increase in profits from a year ago. But let me just remind our listeners that in the past year to 18 months, analysts have been so blatantly and broad-brushed negative on the Canadian banks. It was always going to be a poor quarter. Next quarter was always going to be a poor quarter, and the banks continue to surprise. Now the analysts are looking at what has been going on, the way that the banks have really brought their costs into line. They've gone into more technology, and they're looking at a 7% increase in profits from a year ago. Now, we're going to see starting this week, but it doesn't sound so implausible. And the bank stock prices are reflecting what the investors think that increase in profits might be.
Yeah, real key there, by the way. You know, we talk about it on a regular basis, but the impact of technology on lowering costs, but the job impact too, because we've seen a reduction in staffing there. So that's going to be interesting. But I wanted to come to something else. You just mentioned, Donald Trump removing Dodd-Frank, but one of the things that he's been talking about, or at least his administration, the Republicans who are controlling the House and the Senate, is this border adjustment tax. Canadians are rightfully so worried about it. It's complicated, but the bottom line, it would mean that if they import Canadian stuff to produce in their manufacturing, the U.S. manufacturer can't write it off as a cost. That's a huge change, 20-25% of their cost, calculation. So that's been a big worry there. But this week we seem to, at least from a Canadian perspective, get some good news on that.
Well, we did. It started with Trudeau's visit last Monday, which seemed to go amazingly well. But then through the week, Trump had a big meeting. I think this might have been the catalyst, Mike. He had a big meeting with major U.S. retailers, and that may have started to turn the tide because these retailers, the likes of Penny's, Target, Gap, Walgreens, Walmart, they're warning the president that if they have to start to worry about a border adjustment tax, that they are going to be hit because they import so much in the manufacturing or sale of merchandise. The big retailers obviously import so much, and if their costs start to go up, the costs go up to consumers. It will hit their profits, but more so, it will hit the Donald Trump electorate, those who voted for Trump. They're middle-class Americans, and they are not big wage earners. And if you see costs go up in the likes of the major retailers, it's going to significantly affect them. And you know what? That border tax, Mike, was what was going to pay for the big corporate tax cut. So it would be what we call revenue neutral. You get the big corporate tax cut from the Republicans, and then the border tax would make up the revenue to the government. And now there's a big step back and a pause and a deep breath. So if they don't do the border tax, which is looking more and more like they won't, what happens to the tax cut?
Well, the other thing I think what's really telling, though, when the Republican Senate Majority Whip said, I don't think this thing's on.
You know what? He said it so well. They need 51 senators, 218 House members, and one president in order to get that border tax through. And he went on to say, I think we have to look for other options. I don't know what those options are, Mike, but boy, I can tell you, if Canada's taking or having a sigh of relief, you can imagine what's going on with Mexico if this border tax doesn't make it.
Yeah, I think that's, as I say, good news for Canadians. Mike, we'll be back next week with you. Go out and have a terrific weekend.
You too, Mike. Thanks.
Hey, we're going to come back here. We got a big fat idea for you, and I want you to stay tuned for my quote of the week this week. But coming up, Patrick Ceresna, Chief Derivative Market Strategist. Hey, he's got a way. We talked about oil at the World Outlook Conference, thanks to Joseph Schachter, who I've loved his work. Patrick Ceresna has a way of playing that oil market that maybe you should consider, at least put on the radar screen, with our big fat idea coming up next. We have not been able to track down Patrick Ceresna, Chief Derivative Market Strategist at Learn to Trade Global, so I will share with you his big fat idea. At the World Outlook Conference, we were talking with Joseph Schachter. He did a wonderful presentation that you can get online if you go to moneytalks.net and sign up for it. But a great presentation. He's got a great track record. But what Joseph is looking for is a decline in the markets at this point to come off those highs. Now, we've seen 4 consecutive weeks of negative data coming out, including this build in inventory that we just saw last week. I think it was 9.5 billion in inventories was built versus 1.5 million barrels was the estimate. So that's big. So we've got really big historical inventory levels. If you think that's going to translate back into the market, give it an excuse to literally take profits off that, because there's a lot of profits in the last year. Keep in mind, a year ago, oil was $26 a barrel. So if you want to play the downside and play it for a while, you can use the crude oil exchange traded fund, ETF. That is USO on the symbol. USO is the symbol. That's easy to do, by the way, just to play it to go down. It's also RSP eligible. It's TSFA eligible, that kind of stuff. So I had a look at it. Right now, that symbol is trading at $11.40. And you can buy a put option, let's say at $12. That means if oil even stays the same, you're going to make some money, but goes down from here. that you make money. That's the point here. We're trying to make money as oil goes down. So right now, think about this with me. I know these are numbers coming at you. In the market, it's $11.40. But you can buy the right to sell someone that at $12 right through to July. It'll cost you to have that sort of insurance policy. It could cost $1.20. So it's about 10% of the cost of the shares. So right now, I mean, if you have oil drop to the mid 40s or low 40s, you're going to find that option goes up in price. That's a way of playing the oil market to go down. And that's why I'm always keen on exchange traded funds, by the way, that this is an easy way of playing different strategies. I think it's obsolete to think you only have to play the market to go up in a single direction. I mean, one of the biggest winners we've had on Money Talks in the last several years is our premise that the European Union is going to go under, that it's not going to be. Brexit obviously was, has made that a correct projection, but we were making it back in 2009 to begin with, anticipating the Greek financial crisis and and the sovereign debt crisis to come. Well, at that point, the euro was trading at $1.60. It's now trading somewhere around $1.06, $1.07. That's a big gain. We've added to that trade several times, but the point is we didn't want to miss out on the opportunity to play that market to go down. So we're doing this with oil right now. That's the recommendation, or that's the big fat idea from Patrick. But as I say, it's very consistent with Joseph Schachter thought we'd get a short-term drop in the oil market. This would be one way to play it. You go to the exchange traded fund. It's called USO as a symbol. Trades at $11.40. You buy the right to sell someone that at $12. It costs you about $1.20. If the shares indeed do drop, if oil prices do drop, you'll participate. Let's say they go down to about $10. Well, you're going to make some good money on that. Now, who's it for, by the way? This is for I think basically, even so, I would call this an aggressive investment. You're not leveraged, so it's not more than that, but it's an aggressive investment. It's obviously, you play it for the next 3-4 months, you watch it. You don't have to keep it all 4 months, but if you get that drop, then you take it off and take your profit. But again, it's just an interesting strategy to help you get by. I'm going to take a break. Just a reminder, by the way, as I did say with that we do have the World Outlook Conference videos online. Go to moneytalks.net, plus our daily update. But here's this. I've got my quote of the week. I want you to listen to it, followed by Dr. Michael Berry. This is a guy who presents to the Federal Reserve. So much to talk about. And I've got a great shocking stat that every Canadian should know about, all in the Money Talks Network. Stay with us.